Hello and welcome. Thank you for joining me on this journey. Over the next several chapters, we are going to embark on a path to build a stronger, more confident relationship with a topic that affects every single one of us, every single day. Our finances. For many people, the world of finance can feel intimidating. It can seem like a private club with its own secret language, filled with jargon and complex terms designed to confuse. You might hear words on the news, read them in articles, or have them mentioned by a bank representative, and you nod along, but a small part of you feels uncertain about what they truly mean. If you've ever felt that way, I want you to know that you are not alone. The goal of this entire series is to demystify that language. We're going to take 10 of the most essential financial terms in the United States and break them down, piece by piece, until they are not just words, but tools that you can use to understand and navigate your own financial life with greater clarity. Before we dive in, it is absolutely crucial to establish the purpose of this. The information provided here is for educational and informational purposes only. I am not a licensed financial advisor, a tax professional, or a legal expert. The content in this series is not, and should not be considered, financial, investment, tax, or legal advice. Personal financial situations are unique, and any decisions you make should be done in consultation with qualified professionals who can assess your individual circumstances. Our objective here is to empower you with knowledge, so you can have more informed conversations and make decisions with a solid foundation of understanding. This series is about defining the tools, not telling you how to build your house. So why start with vocabulary? Think about learning any new skill. If you wanted to learn how to cook, you would first need to know the difference between sauté, bake, and broil. If you wanted to build furniture, you'd need to understand what a miter saw does versus a jigsaw. Finance is no different. The words are the building blocks. Without a clear understanding of the terminology, it's nearly impossible to grasp the concepts. Understanding the vocabulary is the first and most critical step toward financial literacy. It's the foundation upon which all other knowledge is built. It gives you the ability to read a bank statement, understand a news report about the economy, or comprehend the terms of a loan, all without feeling lost or overwhelmed. Our journey through these 15 chapters is designed to be a gradual learning process. We will start from the ground up. In this first chapter, we will lay the groundwork, exploring why this knowledge is so powerful. In the chapters that follow, we will dedicate time to each of the 10 core terms, exploring them in depth with real-world examples. We will then move on to see how these terms interact with each other in everyday life, connecting the dots to form a bigger picture. Finally, we'll conclude with how you can continue your learning journey. Let's begin with a simple but powerful idea. Financial wellness is not about being rich. It's about being in control. It's about having a sense of security that comes from understanding where your money comes from and, just as importantly, where it goes. The feeling of control, or the lack thereof, is often tied directly to our understanding of our own financial situation. And the very first step to gaining that control is to conduct an honest assessment of your financial reality. This brings us to the conceptual doorstep of our first essential term. Before we name it, let's think about what it represents. Imagine a captain steering a ship. For the captain to guide the ship to its destination safely and efficiently, they need to know two fundamental things at all times: their current position and the resources they have on board, like fuel. Without this information, they are simply drifting. In personal finance, your ship is your financial life. Your destination could be any number of goals: saving for a down payment on a house, planning for retirement, paying off debt, or simply having a financial safety net. To reach those goals, you need to know your financial position right now. You need a map. This map is created by tracking two fundamental flows of money: what comes in and what goes out. This is the bedrock of all personal finance. Let's talk about money coming in. In financial terms, this is often called income. For most people, income primarily comes from a salary or wages from a job. This is your paycheck. But income can also include money from other sources. Perhaps you have a side business, or you do freelance work. Maybe you receive income from investments, like dividends from stocks, or from a rental property. It could even be irregular income from selling items you no longer need. The first step in drawing our financial map is to have a clear and honest picture of all the money that flows into our lives over a given period, typically a month. Now let's look at the other side of the equation: money going out. In the world of finance, these are called expenses. This is everything you spend money on. And just like income, it's crucial to have a detailed understanding of where it all goes. Expenses can generally be broken down into a few categories, which can be incredibly helpful for understanding our spending habits. First, you have fixed expenses. These are the costs that are generally the same every single month. They are predictable. Think of your rent or mortgage payment, a car payment, your cell phone bill, or insurance premiums. You know they are coming, and you know the amount. They form the predictable financial baseline of your life. Second, you have variable expenses. These are the costs that change from month to month. This is often where our money disappears without us realizing it. Groceries, gasoline for your car, utility bills like electricity which can fluctuate, entertainment like going to the movies or out to eat, and shopping for clothes are all examples of variable expenses. They require more attention to track, because they are not constant. Finally, some people have periodic or occasional expenses. These don't happen every month, but they do happen, and they can be significant. Think about car repairs, annual subscription renewals, holiday gifts, or a vacation. If we don't plan for them, these expenses can suddenly appear and cause a great deal of financial stress. So, we have income, the money coming in, and we have expenses, fixed, variable, and periodic, the money going out. The relationship between these two is what defines your financial reality at this very moment. If your income is greater than your expenses, you have a surplus. This surplus is your most powerful tool for building wealth and achieving your goals. If your expenses are greater than your income, you have a deficit, which often leads to accumulating debt and financial stress. The simple act of observing and tracking these two flows of money is the most empowering first step you can take. It's not about judging your past spending. It's not about feeling guilty. It is simply about gathering data. It's about creating your map. Without this map, you are navigating blind. With it, you can begin to make conscious, informed decisions about where you want to go. This entire process of tracking income and expenses to create a plan for your money has a name. And that name is our first essential financial term, which we will explore in its entirety in our next chapter. That term is budgeting. Many people hear the word budget, and they immediately think of restriction, of saying no to everything, of a financial diet that is painful and impossible to maintain. I want to encourage you to start thinking about it differently. A budget is not a restriction, it is a permission slip. It's a plan that gives you permission to spend your money in a way that aligns with your goals and values. It is the tool that takes you from being a passenger in your financial life to being the driver. In our next chapter, we will dive deep into the concept of a budget. We'll discuss why the negative perception of budgeting exists and how to overcome it. We'll explore several different methods for creating a budget, from simple pen and paper techniques to modern apps that do most of the work for you. We will show you how creating and using a budget is not about deprivation, but about empowerment. It is the foundational skill that makes understanding all other financial terms meaningful. Thank you for taking this first step with me today. The journey to financial literacy can feel long, but it begins with a single step: the decision to learn. You have taken that step. I look forward to you joining me in Chapter 2, where we will fully unpack our first essential term, budgeting. Welcome back. In our first chapter, we laid the foundation for our financial journey. We talked about the importance of understanding the language of money and introduced the core concept of financial mapping, tracking the flow of income coming in and expenses going out. We ended by naming the tool that brings this all together, the budget. Today, we are going to take that concept and bring it to life. As we discussed, the word budget often carries a negative weight. For many, it conjures images of spreadsheets filled with intimidating numbers, of cutting out all the joy from life, of a constant struggle to stay within strict, unforgiving limits. If that's how you viewed budgeting in the past, my goal for this chapter is to offer you a new perspective. Let's reframe what a budget truly is. A budget is not a cage designed to trap you. It is a blueprint designed to build your future. It is not a tool for restriction. It is a tool for intention. It doesn't tell you what you can't do. It empowers you to do what you want to do by creating a clear path to get there. A budget is simply a plan for your money. It's you telling your money where to go, instead of wondering where it went. By creating this plan, you transform money from a source of stress and anxiety into a tool that serves your life and your goals. One of the most important things to remember is that a budget is a living, breathing document. It's not a test that you can pass or fail. Life happens. An unexpected expense might pop up, or your income might fluctuate one month. That's okay. The point of a budget is not to be perfect, but to be aware. It's about having a baseline to return to, a map to consult when you feel lost, so you can make small adjustments and get back on track. So, how does one actually create a budget? There is no single right way to do it. The best budget is the one that you can understand. that feels manageable, and that you will actually use consistently. The goal today is not to tell you which method to choose, but to present several common and effective strategies. This is for informational purposes, so you can see the different options that exist and explore what might resonate with your personal style. Let's start with a very popular and straightforward approach, often recommended for beginners: the 50/30/20 rule. This method provides a simple framework for dividing your after-tax income. The idea is to allocate your money into 3 broad categories: 50% for needs, 30% for wants, and 20% for savings and debt repayment. Let's break that down. First, the 50% for needs. This category covers all of your absolute essentials. These are the expenses you must pay to live. This includes things like your housing payment, rent or mortgage, essential utilities like electricity and water, groceries, transportation to get to work, and minimum insurance payments. These are the non-negotiables. Next, the 30% for wants. This category is for everything that makes life more enjoyable, but isn't strictly necessary for survival. This is where your lifestyle spending fits in. It includes things like dining out, entertainment such as movie tickets or streaming subscriptions, hobbies, travel, and shopping for non-essential items. This category is often the most flexible, and it's where you can make adjustments if you need to free up more money for your other goals. Finally, we have the 20% for savings and debt repayment. This is the portion of your income that you use to build your financial future and handle your past obligations. This includes making payments on debts beyond the minimum requirement, like paying extra on a student loan or credit card balance. It also includes putting money into an emergency fund, saving for a down payment on a home, or contributing to retirement accounts. The beauty of the 50/30/20 rule is its simplicity. It doesn't require you to track every single penny. Instead, it provides broad guidelines to help you balance enjoying your life today with planning for your future tomorrow. Now, for those who prefer more detailed control, there is a method called zero-based budgeting. The philosophy here is simple: income minus expenses equals 0. This doesn't mean you should have $0 in your bank account. It means that before the month begins, you give every single dollar of your anticipated income a specific job. With a zero-based budget, you list all your expected income for the month. Then, you list every single expense you can think of, from your mortgage down to your daily coffee. You assign your dollars to these categories: bills, savings, debt payments, investments, entertainment, until every last dollar is accounted for. Your income minus all your planned spending and saving equals 0. This method is incredibly intentional. It forces you to be conscious of every dollar you earn and spend. It's excellent for identifying where your money is truly going, and for cutting out unintentional or wasteful spending. A popular real-world application of this is the envelope system, where you would physically pull out cash for your variable spending categories, like groceries or entertainment, and put it into labeled envelopes. Once the money in an envelope is gone, you're done spending in that category for the month. In today's digital age, this can be replicated with budgeting apps that allow you to create virtual envelopes for your spending categories. A third, more minimalist approach is known as the pay-yourself-first method. This strategy is for people who find detailed tracking to be tedious and overwhelming. The principle is straightforward. Before you pay any bills, before you buy groceries, before you spend on anything else, you pay yourself. This means you decide on a specific amount or percentage of your income that you want to save or invest. Then, you set up an automatic transfer from your checking account to your savings or investment account for the day you get paid. What's left in your checking account is what you have available for all of your spending for the rest of the month. This method prioritizes your future financial health above all else. By automating your savings, you remove the temptation to spend that money elsewhere. It ensures you are consistently working toward your long-term goals. While it is less detailed than zero-based budgeting, its simplicity and focus on automation make it a very powerful and sustainable strategy for many people. Of course, to implement any of these methods, you need a tool. For some, a simple notebook and pen are enough. Others prefer the organization of a digital spreadsheet. And there are countless budgeting apps and software available today that can connect to your bank accounts, automatically categorize your spending, and help you track your progress toward your goals. Again, the specific tool is less important than the habit of using it. To summarize, a budget is your personal financial plan. It is a powerful tool for gaining control, reducing stress, and aligning your spending with your values. Whether you prefer the simple guidelines of the 50/30/20 rule, the detailed control of a zero-based budget, or the automated simplicity of paying yourself first, the goal is the same: to be the one in charge of your money. Now that we have a plan for our money, our budget, it's time to look more closely at the numbers we're working with. Specifically, the money coming in. You may see a salary number on your job offer, but the amount that actually lands in your bank account is different. Why is that? What happens to your money before you even receive it? In our next chapter, we will demystify the pay stub. We'll introduce our next two essential terms, gross income versus net income, and explore the common deductions that explain the difference between what you earn and what you take home. Thank you for joining me today. I look forward to continuing this journey with you in Chapter 3. Hello and welcome back. In our last chapter, we transformed the idea of a budget from a restrictive cage into an empowering blueprint for our financial lives. We explored different methods, like the 50/30/20 rule and zero-based budgeting, as tools to create an intentional plan for our money. But any good plan requires accurate information. To build a budget that actually works, we need to be crystal clear about the number we are working with, the actual amount of money we have available to spend, save, and invest. This brings us to the heart of today's topic, the journey your money takes from what you earn to what you actually receive. Today, we demystify the paycheck by defining two of the most fundamental terms in personal finance: gross income and net income. Let's start with the big number, the one you likely discussed when you accepted your job. This is your gross income. Gross income is the total amount of money you earn from your employer for a specific pay period, before any deductions are made. If you are a salaried employee, your gross income is a fraction of your total annual salary. For example, if your annual salary is $60,000 and you are paid monthly, your gross monthly income is $5,000. If you are an hourly worker, your gross income is your hourly wage multiplied by the total number of hours you worked during that pay period. Think of gross income as the sticker price of your earnings. It's the starting point, the top-line figure that represents the full value of your work for that period. It's an important number, but it's not the amount of money you can actually use for your budget. So, if you earn $5,000, why isn't that the amount that gets deposited into your bank account? The answer lies in the space between gross income and net income. This space is filled with something called deductions. Deductions are the various amounts of money that are subtracted from your gross pay. These subtractions cover a range of obligations and benefits, primarily taxes and contributions to benefit plans. To use an analogy, imagine your gross income is a freshly baked pie. Before you get to take your slice home, several other required slices are cut and distributed first. What's left for you is your slice. Those other pieces that are taken out are the deductions. Understanding these deductions is the key to understanding your paycheck. Let's walk through some of the most common categories of deductions you might see on a pay stub in the United States. It's important to remember that the specifics can vary greatly depending on where you live, who you work for, and the choices you make regarding benefits. This is a general overview for informational purposes only. First, we have the mandatory deductions, which are primarily taxes. One of the largest is likely to be federal income tax. This is money paid to the U.S. federal government. This revenue is used to fund national programs and services, such as the military, infrastructure like highways, national parks, and various government agencies. Next, depending on where you live, you will likely see deductions for state and local income tax. Not every state has an income tax, but most do. This money funds state and local level services that impact your community directly, such as public schools, local police and fire departments, and road maintenance. Another mandatory deduction you will see is for FICA. FICA stands for the Federal Insurance Contributions Act. This is not actually an income tax, it is a payroll tax, and it's split into two parts. The first part is Social Security, which funds a national program providing retirement, disability, and survivor benefits to millions of Americans. The second part is Medicare, which is the federal health insurance program primarily for people who are 65 or older. When you see FICA taxes deducted, you are contributing to these national social safety net programs. Beyond these mandatory taxes, you will often find deductions related to employee benefits. These are often referred to as pre-tax deductions, meaning the money is taken out of your gross pay before income taxes are calculated, which can sometimes lower the amount of income you are taxed on. A very common example is a deduction for health insurance premiums. If you receive health, dental, or vision insurance through your employer, this deduction represents your portion of the monthly cost for that coverage. Another common pre-tax deduction is for retirement savings. You might see this listed as a contribution to a 401k or a 403b plan. This is an amount of money that you have chosen to save for your retirement, and it is deducted directly from your paycheck and deposited into a special investment account. After all of these deductions, federal, state, and local taxes, FICA contributions, and pre-tax contributions for benefits like health insurance and retirement, what you are left with is your net income. Net income is the final amount of money that you take home. It is your gross income minus all deductions. This is the number that is actually deposited into your bank account on payday. It is often called your take-home pay for this very reason. And this is the most important point of our chapter today. You build your budget using your net income, not your gross income. If you create a budget based on that big, top-line gross income number, your plan will fail from the start, because you will be planning with money that you never actually receive. Financial clarity begins with being honest about the true amount of money you have to work with each month. And that number is your net income. To summarize, gross income is what you earn. Net income is what you keep after all taxes and other deductions are taken out. Your pay stub is the document that tells the story of how one becomes the other. It is important to state again that tax laws and benefit structures are complex and highly specific to individual situations. For any personal questions or advice regarding your taxes or paycheck deductions, it is always recommended to speak with a qualified tax professional or your company's human resources department. Now that we understand the actual income we have to work with, and we have a plan for it from our work in the last chapter, we need a secure and efficient place to manage this money. How do we hold it, spend it, and save it? In our next chapter, we will explore the foundational tools of our daily financial lives. We'll define our next two essential terms: checking accounts and savings accounts. Thank you for your time today. I hope you'll join me for Chapter 4 as we continue to build our financial knowledge, step by step. Hello and welcome back to our journey toward financial clarity. In our previous chapters, we've laid some critical groundwork. We started by understanding why financial vocabulary is so important. Then, we learned how to create a budget, which is our personal plan for our money. Most recently, we demystified our paychecks by learning the difference between gross and net income, identifying the actual take-home pay that fuels our budget. So now you have a plan and you have the money for that plan. The next logical question is, where do you put that money? How do you manage it on a day-to-day basis in a way that is safe, secure, and organized? Today, we are going to explore the two most fundamental tools in the entire financial system, the accounts that form the bedrock of daily money management for millions of Americans. We are going to define and differentiate between checking accounts and savings accounts. Let's begin with the account that acts as the central hub of your financial life, the checking account. A checking account is best understood as a transactional account. Its primary purpose is to handle your daily cash flow with ease and efficiency. Think of it as the grand central station of your finances. It's where your income, typically through direct deposit, arrives. And it's from this station that your money departs to cover your expenses, your rent, your utility bills, your groceries, and your daily coffee. It is designed for a high volume of transactions. The key feature of a checking account is its liquidity. In financial terms, liquidity simply means how quickly and easily you can access your money. Checking accounts are highly liquid. You can get your cash instantly from an ATM, pay for something at a store with a debit card, write a physical check, or send money electronically through an online bill pay system. This immediate access is what makes it the perfect tool for your everyday spending and bill payments as outlined in your budget. Common tools associated with a checking account include a debit card, which lets you make purchases directly from the funds in your account, and access to online banking and mobile apps for transferring money and paying bills. However, because these accounts are built for convenience and frequent transactions, they are generally not designed for growing your money. Most standard checking accounts offer very low, or even zero, interest on the money you keep in them. It's also important to be aware that some checking accounts may come with certain fees, such as monthly maintenance fees if a minimum balance isn't maintained, or overdraft fees if you spend more money than you have in the account. The specific features will always vary by the financial institution. Now, if the checking account is the busy hub for your daily spending, where do you put the money you don't intend to spend right away? This brings us to its essential partner, the savings account. A savings account has a fundamentally different purpose. It is a place to store money for your future goals, keeping it separate from your daily spending money. It is designed for accumulation, not for transactions. If the checking account is Grand Central Station, the savings account is a secure vault. Money goes in, and it is intended to stay there and grow, even if just by a little, until you need it for a specific purpose. This purpose could be anything you are planning for: an emergency fund to cover unexpected expenses, a down payment for a future home or car, a vacation, or any other medium to long-term financial goal. A key feature that distinguishes a savings account is that it pays you interest. Interest is, in simple terms, the money the bank or credit union pays you for keeping your funds with them. You will often see this expressed as an APY, which stands for annual percentage yield. The APY tells you the total amount of interest your money will earn over the course of 1 year, including the effect of compounding, where you earn interest not just on your initial deposit, but also on the interest that accumulates over time. To encourage saving, these accounts are intentionally less liquid than checking accounts. While you can certainly access your money, they are not designed for frequent withdrawals. In fact, federal regulations historically limited the number of certain types of withdrawals and transfers you could make from a savings account each month. While some of these restrictions have been relaxed, the principle remains. A savings account is for saving, not for daily spending. This small amount of friction can be a helpful feature, as it makes you pause and think before dipping into your savings for a non-essential purchase. So, we have these two powerful tools. But what makes them safe? In the United States, there is a crucial system of protection for your deposits. For banks, this is provided by the FDIC, which stands for the Federal Deposit Insurance Corporation. For credit unions, it's the NCUA, or the National Credit Union Administration. Both the FDIC and NCUA are independent agencies of the United States government. Their purpose is to protect the money you deposit in the very unlikely event that your bank or credit union fails. The standard insurance amount is currently $250,000 per depositor per insured institution for each account ownership category. This insurance is a foundational element of the U.S. banking system, providing a safety net and a sense of security that the money you place in these insured accounts is protected. In summary, a checking account and a savings account are two different tools for two very different jobs. The checking account is for your daily spending. It's transactional, highly liquid, and pays little to no interest. The savings account is for your future goals. It's for storage, is less liquid, and is designed to earn interest. Using them together allows you to manage your day-to-day expenses efficiently, while simultaneously building a more secure financial future. Understanding the terms and features of any account you open is always a key part of making informed financial decisions. Now that we have a place for our daily transactions and a safe place for our savings, we need to address another major component of the financial world: spending with money that isn't ours, at least not yet. This brings us to a concept that is an incredibly powerful tool when used responsibly, but a significant challenge when misunderstood. In our next chapter, we will demystify one of the most common financial tools in America, the credit card. Thank you for being here today. I look forward to seeing you in Chapter 5. Hello and welcome back. In our journey so far, we have built a solid foundation. We've established a budget to plan our finances, learned to identify our net income to fuel that plan, and explored checking and savings accounts as the primary tools for managing the money we have. Today we pivot to a different, but equally important, concept: a tool that allows us to make purchases with money we borrow. We are going to define and demystify one of the most widely used and most misunderstood financial products in the United States: the credit card. It's likely you have one in your wallet, or you've seen them used everywhere from the grocery store to online shopping carts. But what is a credit card at its core? It is fundamentally different from the debit card we've discussed. When you use a debit card, money is immediately withdrawn from your own checking account. It's your money. A credit card, on the other hand, works on a different principle. When you make a purchase with a credit card, you are borrowing money from the financial institution that issued the card, such as a bank. You are making a promise to pay that money back at a later date. Each swipe, tap, or online entry is essentially a small, instant, unsecured loan. Understanding this core difference, debit is your money, credit is borrowed money, is the first and most critical step. Because it's a form of borrowing, a credit card comes with a specific set of rules and terms. Understanding this terminology is essential to understanding how the tool works. Let's break down the key components you will encounter.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
First is the credit limit. This is the maximum amount of money the card issuer will allow you to borrow at any given time. For example, if a card has a credit limit of $5,000, you can make purchases up to that amount. Once you reach the limit, you cannot charge any more until you pay down some of the borrowed amount. This limit is determined by the financial institution based on a variety of factors. Your credit card activity is tracked in what is called a billing cycle, which is typically about 1 month long. At the end of each billing cycle, the card issuer will send you a statement. This statement is a summary of all your activity during that cycle. Every purchase you made, any payments you sent, and any fees or interest charged. The statement will also show your total balance due and a payment due date. This brings us to one of the most important terms in the world of credit: the annual percentage rate, or APR. The APR is the cost of borrowing the money, expressed as a yearly interest rate. If you do not pay your entire balance back in full by the due date, interest will be charged on the remaining amount. Credit card APRs are often significantly higher than the interest rates for other types of loans, like a car loan or a mortgage. This interest is the primary way that card issuers generate revenue from cardholders who carry a balance from 1 month to the next. However, credit cards also have a powerful feature called a grace period. The grace period is the time between the end of your billing cycle and your payment due date. Here is the crucial rule of a grace period. If you pay your entire statement balance in full before the due date, you are typically not charged any interest on those purchases. In effect, you have received a short-term, interest-free loan. This feature is what allows a credit card to be used as a simple payment tool without incurring any cost of borrowing. On your statement, you will also see a minimum payment. This is the smallest amount of money your card issuer requires you to pay by the due date to keep your account in good standing. It is very important to understand what happens when you pay only the minimum. While it prevents you from being charged a late fee, the rest of the balance, the amount you did not pay, is carried over to the next month. Interest, calculated using the card's APR, is then applied to that carried over balance. Because the interest itself is added to the balance, you can begin to pay interest on your interest in a process called compounding. This is how credit card debt can grow quickly over time. Like any tool, a credit card has inherent features that can be viewed in different ways depending on how it's used. For informational purposes, some of these commonly described features include convenience, as you don't have to carry large amounts of cash. They also typically offer stronger fraud protection than debit cards. Federal law limits a cardholder's liability for unauthorized charges. Many cards also offer rewards programs, such as cashback or travel points, as an incentive for using the card. On the other side, the primary risk associated with credit cards is the potential for accumulating debt. The combination of high APRs and the compounding of interest on balances that are carried from month to month can make it challenging to pay off what is owed. There can also be various fees, such as annual fees for holding the card, late payment fees, or fees for exceeding your credit limit. In essence, a credit card is a revolving line of credit. It's a tool that offers flexibility and certain protections, but it functions based on a strict set of rules outlined in a legal document called the Card Member Agreement. Understanding these rules, especially the relationship between the grace period, the APR, and the minimum payment, is the key to understanding the product itself. The Card Member Agreement for any card details all of its specific rates, fees, and terms. The way a person manages their credit card payments is one of several financial behaviors that is reported to credit bureaus. This information is then used to generate another important financial concept, one that can impact many areas of life, from the ability to get a car loan to renting an apartment. In our next chapter, we will introduce and define this essential term, the credit score. Thank you for joining me today. I look forward to exploring the world of credit scores with you in Chapter 6. Hello and welcome back. In our last chapter, we took a close look at the credit card, understanding it as a financial tool for borrowing money. We concluded by mentioning that how you manage credit is information that gets tracked. This leads us directly into today's topic, a concept that is often talked about but frequently misunderstood. Today, we will define and explain the credit score. Before we dive in, it's important to frame this concept correctly. A credit score is not a judgment of your personal worth. It is not a grade on you as a person. Rather, it should be viewed as a financial snapshot, a summary of your history with credit at a specific moment in time. It is a tool used within the financial industry, and understanding what it is and how it is derived is another key piece of financial literacy. So, what exactly is a credit score? At its most basic, a credit score is a 3-digit number, typically ranging from 300 to 850. This number is generated by a computer algorithm that applies a complex mathematical formula to the information found in your credit report. The purpose of this score is to predict the statistical likelihood that a person will repay borrowed money on time. Lenders, such as banks and credit card companies, use this score as one of several factors to help them assess the risk associated with lending money. A higher score is generally interpreted by lenders as indicating a lower risk of default, while a lower score may be seen as indicating a higher risk. To understand the score, we first have to understand its source, the credit report. A credit score is simply a numerical summary of what's in your credit report. The report itself is the detailed document. It contains a history of your financial activities related to credit, including a list of your credit accounts, your payment history on those accounts, and other information related to your borrowing and repayment habits. In the United States, this information is collected and maintained by companies known as credit bureaus. The three major nationwide credit bureaus are Equifax, Experian, and TransUnion. Lenders and creditors voluntarily report information to these bureaus, which then compile it into your individual credit report. Now, let's explore the general categories of information that credit scoring models, like the well-known FICO and VantageScore models, typically analyze to calculate a score. This is for informational purposes only, to illustrate how the system functions. The first and often most significant factor is payment history. This category is a record of whether you have paid your past credit obligations on time. It includes information on payments for credit cards and loans. The presence of late payments, or more significant events like accounts being sent to collections or a bankruptcy filing, is all part of this payment history record. The second major factor is often referred to as amounts owed. This category looks at how much debt you are carrying. A key component here is the credit utilization ratio, particularly on revolving accounts like credit cards. This ratio compares the amount of credit you are currently using to the total amount of credit you have available. For example, if you have one credit card with a $5,000 balance and a $10,000 credit limit, your credit utilization ratio on that card is 50%. Scoring models analyze this percentage as one piece of the overall financial picture. A third factor is the length of credit history. This refers to how long you have been using credit. It considers the age of your oldest credit account, your newest account, and the average age of all your accounts. A longer history provides more data for a scoring model to analyze. Fourth is the concept of credit mix. This category looks at the different types of credit accounts you have. This can include a mix of revolving credit, like credit cards, and installment loans such as a car loan, a student loan, or a mortgage, where you make regular, fixed payments over a set period. Finally, the fifth category is new credit. This factor takes into account your recent credit activity. It looks at how many new accounts you've recently opened and also tracks hard inquiries. A hard inquiry is a record that is created when a lender checks your credit in response to your application for new credit. Numerous hard inquiries in a short amount of time are a data point that is considered by scoring models. It's important to know that you have the right to see the information in your credit reports. In fact, United States federal law entitles you to a free copy of your credit report from each of the three major credit bureaus, Equifax, Experian, and TransUnion, once every 12 months. The official, federally authorized website for requesting these reports is annualcreditreport.com. In summary, a credit score is a dynamic number calculated from the detailed information in your credit report. These reports are compiled by credit bureaus and contain your history with credit. This score is used by lenders as a tool to help them assess risk. The world of credit is intricate, and the models used to calculate scores are proprietary and complex. The information here serves as a basic overview of the concepts. Now that we have covered the fundamentals of budgeting, income, banking, and credit, it's time to shift our focus toward the future. A major financial goal for many is planning for a time when they will no longer be working. But the language around saving for this goal can be just as confusing as the language of credit. In our next chapter, we will begin to explore the world of long-term savings by defining two of the most common types of retirement accounts you will hear about: the 401k and the IRA. Thank you for being here today. I look forward to you joining me for Chapter 7. Hello and welcome back. Over the past several chapters, we have constructed a detailed picture of day-to-day financial life. We've learned about budgeting our money, understanding our income using bank accounts, and navigating the world of credit. Now, our journey takes an important turn. We are shifting our focus from the present to the future. For many people, one of the largest and most important financial goals is planning for retirement, a time when they can choose to stop working. Today, we will introduce the primary tools designed for this purpose by defining two terms you will hear constantly in discussions about long-term savings: the 401k and the IRA. Before we define them separately, it's crucial to understand what these accounts are at a high level. A 401k or an IRA is not an investment itself. Instead, it's best to think of them as special types of accounts, like a container or a basket, that are designed to hold investments. What makes them special is that they are given significant tax advantages by the government to encourage people to save for the long term. Because they are designed specifically for retirement, there are rules to keep the money in place, such as potential penalties for withdrawing funds before a certain age, typically 59 and a half. Let's start with the one you are most likely to encounter through your job, the 401k. A 401k plan is a retirement savings plan sponsored by an employer. It gets its name from the specific section of the U.S. Internal Revenue Code that established it. You may hear similar plans for employees of nonprofit organizations referred to as a 403b, but they function in a very similar way. Here's how a 401k generally works. An eligible employee can choose to contribute a certain percentage of each paycheck directly into their 401k account. This happens automatically, making it a consistent way to save. The money in the account is then invested in a menu of options, typically mutual funds, selected by the employer. The primary feature of a traditional 401k is its tax treatment. Contributions are usually made on a pre-tax basis. This means the money is deducted from your paycheck before federal and state income taxes are calculated. This has the effect of lowering your total taxable income for the year. Inside the account, the investments can then grow tax-deferred. This means you do not pay taxes on any investment gains, like dividends or appreciation, year after year. The taxes are deferred until you begin to withdraw the money in retirement. At that point, the withdrawals are treated as ordinary income. Another very common and powerful feature of 401k plans is the employer match. This is a program where your employer contributes to your account as well. A common example is a company matching 100% of an employee's contributions up to the first 3% of their salary. This is a key feature of many employer-sponsored plans. Some companies may also offer a Roth 401k option, which we will explain in more detail shortly. Now, what if you don't have access to a 401k through an employer, or you want to save more for retirement on your own? This is where our second term comes in, the IRA, which stands for Individual Retirement Arrangement. As the name implies, this is a retirement account that any individual with earned income can typically open on their own through a financial institution, like a bank or a brokerage firm. IRAs come in two main types, and the difference, once again, is all about taxes. First, there is the traditional IRA. A traditional IRA is similar to a traditional 401k. Contributions you make to a traditional IRA may be tax deductible, depending on your income and whether you have a retirement plan at work. Just like a 401k, the investments in the account grow tax deferred, and you pay income taxes on the money when you withdraw it in retirement. The second type is the Roth IRA. A Roth IRA works in the opposite way from a tax perspective. Contributions to a Roth IRA are made with post-tax dollars. This means you do not get an upfront tax deduction for your contributions. You are contributing money that has already been taxed. However, the major benefit of the Roth structure is that your investments grow completely tax-free. And provided certain conditions are met, all of your qualified withdrawals in retirement are also completely tax-free. The choice between a traditional or Roth structure, whether in a 401k or an IRA, involves a trade-off. Do you want the tax break now, traditional, or do you want the tax break later, Roth? The answer depends on an individual's personal financial situation, their current income, and what they expect their income and tax rates to be in the future. It is absolutely essential to state that this information is a simplified overview for educational purposes. It is not tax advice or investment advice. All investments involve a degree of risk, including the potential loss of your initial investment. Deciding how and where to save for retirement is a major financial decision, and it is highly recommended to consult with a qualified, licensed financial advisor and a tax professional to discuss your personal circumstances. In summary, 401k, and IRAs are tax-advantaged accounts designed to help you save for retirement. A 401k is an employer-sponsored plan, while an IRA is an individual account. Both often come in traditional pre-tax and Roth post-tax versions, each with its own set of rules and tax implications. Now, we've mentioned that inside these accounts, your money is invested. It doesn't just sit there like cash in a savings account. To truly understand how these accounts work, we need to understand the basic assets held within them. In our next chapter, we will define and explore two of the most foundational concepts in the world of investing: stocks and bonds. Thank you for joining me today as we look toward the future. I hope you'll join me for Chapter 8. Hello and welcome back. In our last chapter, We open the door to long-term financial planning by defining retirement accounts like the 401k and the IRA. We describe them as containers, designed to hold investments and help them grow in a tax-advantaged way. Today we are going to look inside those containers. We will define two of the most fundamental and common types of investments you will ever hear about: stocks and bonds. Before we begin, it is absolutely essential to state the purpose of this chapter. Our goal is purely educational. We are here to define these terms and explain how they work conceptually. This is not a recommendation to buy, sell, or invest in anything. All investing involves risk, including the possible loss of the money you invest. Any decision to invest should be made only after thorough personal research and, ideally, in consultation with a qualified and licensed financial professional. Our mission today is to build your vocabulary so you can better understand the financial world around you. Let's begin with our first term: stocks. A stock, which is also commonly referred to as a share or as equity, represents an ownership stake in a publicly traded company. When you buy a stock, you are buying a small piece of that company. Imagine a large pizza that is cut into millions of tiny slices. Owning one share of stock is like owning one of those slices. As a part owner, you have a claim on the company's assets and a share in its earnings. There are generally two ways an investor can potentially see a return from owning a stock. The first is through capital appreciation. This occurs if the company does well, and its value increases in the eyes of the market. As the company becomes more valuable, the price of each share of its stock may rise. If an investor sells their stock for a higher price than they paid for it, they have realized a capital gain. The second potential way to earn a return is through dividends. Some companies, often those that are well established and profitable, choose to distribute a portion of their profits directly to their shareholders. This payment is called a dividend. It is important to note that not all companies pay dividends. Many newer or high-growth companies choose to reinvest all of their profits back into the business to fuel further growth. Now we must discuss the other side of the coin, risk. Because a stock represents ownership, its value is directly tied to the performance and perception of the company. If the company performs poorly, faces unexpected challenges, or falls out of favor with the broader market, the price of its stock can go down. It is possible for a stock's value to fall below the price an investor paid for it, resulting in a loss. In a worst-case scenario, if a company goes bankrupt, its stock can become worthless, and an investor could lose their entire investment. Now let's shift gears and turn to our second term, bonds. If a stock represents ownership, a bond represents a loan. A bond is a type of debt. When you buy a bond, you are essentially lending money to an entity. This entity could be a corporation looking to raise money to build a new factory, in which case it's called a corporate bond. Or the borrower could be a government entity, like the U.S. Treasury, looking to fund public projects. These are known as government bonds. In either case, you, the bondholder, are acting as the lender. Bonds have a clear and defined structure. There are three key parts to understand. First is the principal, also called the face value. This is the original amount of the loan. Second is the coupon, which is the interest rate that the issuer promises to pay the bondholder. These interest payments are typically made on a regular schedule, for instance, twice a year. Third is the maturity date. This is the future date on which the loan is fully paid off. On the maturity date, the issuer returns the original principal amount to the bondholder. The potential return from a bond is the series of fixed interest payments you receive over the life of the loan. However, bonds also have risks. The primary risk is called credit risk or default risk. This is the risk that the borrower will be unable to make its promised interest payments, or will be unable to repay the principal at the maturity date. This risk varies greatly depending on the issuer. For example, bonds issued by the U.S. government, known as treasuries, are generally considered to have very low credit risk. Another risk is interest rate risk. This is a more complex concept, but the basic idea is that the market value of a bond can change. If you buy a bond with a 3% coupon rate, and a year later, new bonds are being issued with a 5% rate, your existing bond becomes less attractive. If you needed to sell your bond before its maturity date, you would likely have to sell it at a discount. So let's summarize the fundamental difference. Buying a stock makes you an owner. Buying a bond makes you a lender. Ownership generally involves higher risk, with the potential for higher returns. Lending generally involves lower risk with more predictable, but often lower, potential returns. These two asset types form the basic building blocks of many investment portfolios. Understanding their distinct characteristics is a crucial step in financial literacy. Buying individual stocks and bonds, however, can be a complex process. As a result, A very popular way to invest in a wide variety of them all at once was created. In our next chapter, we will define a term you may have heard in our discussion on 401(k)s, and one of the most common investment vehicles for individuals, the mutual fund. Thank you for joining me today for this definitional overview. I hope to see you in Chapter 9. Hello and welcome back. In our last chapter, we defined the foundational assets of the investing world. Stocks, which represent ownership in a company, and bonds, which represent a loan to an entity. We learned that they have different characteristics and different risk profiles. While an individual can buy single stocks and single bonds, doing so requires a significant amount of research and capital to build a varied portfolio. This brings us to a solution created to address that very challenge. Today, we will define one of the most common investment vehicles available, the mutual fund. As always, a reminder that this chapter is for educational and informational purposes only. The content provided here is not investment advice, nor is it a recommendation to buy or sell any financial product. The goal is to build your vocabulary so you can better understand financial concepts. So, what is a mutual fund? At its core, a mutual fund is a company that pools money together from many different investors. It then takes that large pool of money and uses it to invest in a broad, pre-selected portfolio of stocks, bonds, or other assets. Think of it like a financial potluck. Instead of bringing one large dish that you prepared all on your own, you and many other people each contribute a small amount of money to a collective fund, which is then used to buy a huge variety of dishes for everyone to share. When you invest in a mutual fund, you are not buying the individual stocks or bonds in the fund's portfolio directly. Instead, you buy shares of the mutual fund itself. The price of one share of a mutual fund is called its net asset value, or NAV. The NAV is calculated once per day, at the end of the trading day, by taking the total market value of all the assets the fund owns, subtracting any liabilities, and then dividing that by the total number of shares the fund has issued. The single most important concept associated with mutual funds is diversification. This is a term we must define clearly. Diversification is the practice of spreading your investments across many different assets. The idea behind it is simple. Don't put all your eggs in one basket. If you own stock in only one company, and that company performs poorly, your entire investment is at risk. However, a mutual fund might own stocks in hundreds, or even thousands, of different companies across various industries. In this scenario, if one company in the fund's portfolio does poorly, its negative impact on the overall value of the fund is cushioned by the performance of the many other companies. A mutual fund, by its very nature, provides instant diversification. Mutual funds come in a vast array of types, each with a specific objective. There are stock funds, bond funds, and balance funds that invest in a mix of both. There are funds that focus on specific industries, like technology or healthcare, and funds that invest in companies based in specific countries or regions of the world. Each fund's specific strategy and objectives are laid out in a legal document called the prospectus, which provides all the detailed information an investor would need to know about the fund. When it comes to how a fund's portfolio is managed, there are two primary styles. The first is actively managed. In an actively managed fund, a professional portfolio manager, or a team of them, is responsible for making the investment decisions. They conduct research, analyze market trends, and actively buy and sell securities with the stated goal of outperforming a particular market benchmark, such as a major stock index. The second style is passively managed. A passively managed fund, most commonly known as an index fund, has a different goal. It does not try to beat the market. Instead, its objective is to simply match or replicate the performance of a specific market index. A market index is a statistical measure of the performance of a section of the stock market. A famous example is the S&P 500, which tracks the performance of 500 of the largest U.S. companies. An S&P 500 index fund would simply aim to own all 500 of those companies in the same proportion as the index itself. Because this style of management involves less active decision-making, it can often be implemented with lower costs. This brings us to a critical term associated with mutual funds, the expense ratio. A mutual fund is a business, and it has operating costs. These costs include the portfolio manager's salary, administrative costs, and marketing expenses. To cover these costs, the fund charges an annual fee. This fee is called the expense ratio, and it is expressed as a percentage of your total investment. For example, if you have $10,000 invested in a fund with a 1% expense ratio, the fee for that year would be $100. This fee is automatically deducted from the fund's assets, which in turn reduces the overall return that you, the investor, receive. The expense ratio is a key piece of information found in a fund's prospectus. In summary, a mutual fund is a vehicle that allows investors to pool their money to buy a diversified portfolio of securities. It offers an immediate way to achieve diversification. Funds can be actively or passively managed, and they come with an annual fee known as the expense ratio. We have now covered the core building blocks of the financial world. But in the modern economy, how does all of this come together? Where does the buying and selling of stocks, bonds, and funds actually happen? In our next and final definitional chapter, we will answer that question by defining our last essential term, the stock market. Thank you for being here today. I look forward to you joining me for our 10th and final term in Chapter 10. Hello and welcome back. Our journey through the essential vocabulary of finance has brought us a long way. We started with the personal act of budgeting. We learned about our income, our bank accounts, and how we use credit. From there, we looked toward the future, defining retirement accounts, and then zoomed in on the assets held within them, defining stocks as ownership and bonds as loans. Most recently, we explored the mutual fund as a way to access a diversified collection of these assets. We have defined the individual financial instruments. Now it is time to define the environment where one of the most prominent of these instruments, the stock, is bought and sold on a massive scale. Today we will define our 10th and final essential term, the stock market. As we dive into this complex topic, our usual disclaimer is more important than ever. This chapter provides a definitional and conceptual overview. It is not investment advice. The stock market is inherently unpredictable, and all investments carry risk. Our goal today is simply to understand what the stock market is, and its fundamental purpose in the economy. First, it is important to clarify that the stock market is not a single physical building or one giant entity. It is a broad, collective term that refers to the entire network of exchanges and marketplaces where the shares of publicly traded companies are bought and sold. The fundamental purpose of the stock market is to connect two groups of people. On one side, you have companies that need money or capital to grow. They might need funds to build new factories, conduct research, or expand into new areas. On the other side, you have investors, both individuals and large institutions, who have capital and are looking for a place to put it to work, hoping for a potential return. The stock market is the system that facilitates this connection. This system has two main parts. The first is the primary market. This is where a company sells its stock for the very first time, in an event called an initial public offering or IPO. This is how the company raises capital directly from investors. After the IPO, all subsequent trading of that company's stock happens in the secondary market. This is what most people are referring to when they talk about the stock market. In the secondary market, investors are not buying stocks from the company itself. They are buying and selling the stocks from each other. The company does not receive any money from these transactions. The purpose of the secondary market is to provide liquidity, which is a crucial concept. Liquidity means that an investor who owns a stock can sell it and convert it back into cash in a relatively easy and efficient manner. So where does this buying and selling actually happen? It primarily occurs on regulated marketplaces called stock exchanges. An exchange is an organized market with a specific set of rules and procedures to ensure that trading is fair and orderly. In the United States, two of the most well-known examples are the New York Stock Exchange, NYSE, and the NASDAQ. While they both serve the same core function, they have different histories and structures. The NYSE is famous for its physical trading floor, though much of its activity is now electronic, while the NASDAQ began as, and remains, a fully electronic marketplace. An individual investor cannot simply walk onto an exchange and start trading. To participate in the market, they must use a licensed intermediary known as a broker or a brokerage firm. A broker is authorized to execute trades on an exchange on behalf of their clients. In the modern era, this is typically done through online brokerage platforms. What determines the price of a stock on any given day? The price of a stock at any moment is determined by the timeless principle of supply and demand. If at a particular price, there are more buyers for a stock than there are sellers, the demand will push the price up. Conversely, if there are more sellers than buyers, the excess supply will push the price down. This constant interaction between buyers and sellers is what causes stock prices to fluctuate throughout the day. Because the market is made up of thousands of individual stocks, it can be difficult to get a sense of its overall performance. To solve this, we use stock market indexes. An index is a statistical tool, a curated list of stocks, that provides a snapshot of the performance of a particular section of the market.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
You have likely heard of major indexes like the S&P 500, which tracks 500 of the largest U.S. companies, or the Dow Jones Industrial Average, which tracks 30 large, well-known companies. When you hear a news report say, "The market was up today," they are usually referring to the performance of one of these major indexes. With this definition, we have now covered our 10 essential financial terms. We have built a vocabulary that ranges from the budget you create at your kitchen table to the vast, global network of the stock market. The information in these last few chapters about investing is, by necessity, simplified. We must state again that investing in the stock market involves significant risk and is not suitable for everyone. Personal financial decisions should only be made after careful consideration and in consultation with a qualified and licensed financial professional. We have completed the definitional phase of our series. But how do these 10 terms connect with one another in the real world? In the next phase of our series, starting with Chapter 11, we will move from definition to application. We will begin connecting the dots to see how these concepts work together, starting with a practical look at how budgeting and saving come together to build a personal financial plan. Thank you for joining me on this definitional journey. I look forward to you joining me as we begin to connect these concepts in Chapter 11. Hello, and welcome back. For the past 10 chapters, we have been on a mission of definition. We have carefully unpacked 10 of the most essential financial terms, from the budget you make at home to the global stock market. We have built our vocabulary. Now we begin a new and equally important phase of our journey. We move from definition to application. In these next chapters, we will begin to connect the dots and see how these individual concepts work together to form a cohesive financial picture. Today we will start by assembling the foundational pieces. We will explore how the concepts of your income, your budget, and your savings goals come together to form the blueprint for your financial life. A personal financial plan. You might be wondering, isn't a financial plan just a more complicated word for a budget? That's a common question, but they are two distinct, though deeply connected, ideas. Think of it this way. A budget is tactical, while a financial plan is strategic. Your budget, which we defined in Chapter 2, is your detailed month-to-month tool for managing your cash flow. It answers the question, where is my money going right now? A financial plan, on the other hand, is your long-term roadmap. It looks at the bigger picture and answers the question, where do I want my money to go in the future and why? Your financial plan gives your budget its purpose. A budget without a plan is like steering a ship with no destination in mind. You might be managing the vessel perfectly, but you're not heading anywhere specific. The financial plan is the map and the destination combined. So, what does the framework of a financial plan look like? The first step is always to understand your starting point. This is where our earlier chapters come directly into play. You begin by knowing your numbers. First, you must have a clear picture of your net income, or take-home pay, which we covered in Chapter 3. This is the total amount of resources you have to work with each month. Second, you need to understand where those resources are going by tracking your expenses. This, of course, is the process of budgeting. The outcome of this initial step, analyzing your net income against your expenses, is the single most important number for your financial plan. Your monthly surplus or deficit. A surplus is the money you have left over after all your expenses are paid. This surplus is the raw material, the very fuel, for achieving your future goals. Once you know your starting point and the resources you have available, the next step in the framework is to give those resources a purpose. This is done by setting financial goals. A financial goal is simply a specific objective you want to achieve that requires money. These goals are what transform saving from a chore into a meaningful activity. Financial literature often breaks goals down into 3 time-based categories. Short-term goals are those you typically aim to achieve in 1 to 3 years. This could be something like building an emergency fund, saving for a major vacation, or paying off a small debt. Mid-term goals usually fall within a 3 to 10-year time frame. Common examples include saving for a down payment on a home, saving to buy a car, or planning for a major life event like a wedding. Long-term goals are those that are more than 10 years away. The most common long-term goal for many people is saving for retirement, which connects to the 401k, and IRAs we discussed in Chapter 7. A well-known academic framework for setting effective goals is the SMART acronym. It suggests that goals should be specific, measurable, achievable, relevant, and time-bound. For example, instead of a vague goal like save more money, a SMART goal might be to save $10,000 for a down payment on a house within the next 5 years. This provides a clear target to aim for. With your financial reality understood and your goals defined, the final part of the framework is to create a strategy for allocating your monthly surplus. This is where your budget and your plan become a powerful team. Your plan tells your budget what is most important. A foundational goal in nearly every personal financial plan is the creation of an emergency fund. An emergency fund is a cash reserve that is set aside for one purpose only: to cover major, unexpected expenses. This could be a sudden job loss, an urgent medical bill, or a critical home repair. The purpose of this fund is to provide a financial safety net, so that an unexpected event doesn't force you into debt or require you to derail your long-term investment goals. This money is typically held in a highly liquid account, like the savings accounts we defined in Chapter 4. A common guideline often discussed by financial experts is to build an emergency fund that can cover 3 to 6 months' worth of essential living expenses. Beyond the emergency fund, your strategy involves directing your surplus to your other goals. This often involves the principle of paying yourself first, where you automate the transfer of money from your checking account to different savings or investment accounts, each designated for a specific midterm or long-term goal. In summary, a financial plan provides the strategic direction for your money. It starts with the tactical work of understanding your net income and your budget. It's guided by the purpose you create through setting clear financial goals. And it is put into action by a deliberate strategy for allocating your financial resources. This has been a high-level overview of a conceptual framework. A personal financial plan is, by its nature, deeply individual. For personalized advice and guidance in creating such a plan, the services of a qualified, licensed financial planner are often utilized. Now that we understand how a plan is built, and we've mentioned the importance of a safety net like an emergency fund, it's time to talk about protecting against larger, more catastrophic financial risks. In our next chapter, we will connect our financial vocabulary to the world of risk management by discussing the role of insurance within a financial plan. Thank you for joining me. I look forward to seeing you in Chapter 12. Hello and welcome back. In our last chapter, we took a significant step forward by assembling our previously defined terms into the framework of a personal financial plan. We discussed how a budget serves as the tactical tool to execute the long-term strategy of a plan, which is guided by our financial goals. We also introduced the concept of the emergency fund as a critical safety net for unexpected, but manageable, financial shocks. Today, we are going to expand on that idea of protection. We will address how a financial plan is shielded from larger, potentially catastrophic events that could otherwise derail it completely. We will do this by exploring the role of insurance within a financial plan. First, let's be very clear about our objective. This chapter is for educational purposes only. It is designed to define the concept of insurance and explain its function in a financial context. This is not a recommendation to purchase any specific type of insurance product, nor is it advice on coverage amounts. For any personal decisions regarding insurance, it is always recommended to consult with a qualified and licensed insurance professional who can assess your individual needs and circumstances. So what is insurance? At its core, insurance is a tool for risk transfer. It is a formal contract, called a policy, between an individual or an entity and an insurance company. In this contract, the individual agrees to make regular, predictable payments to the company. This payment is called a premium. In exchange for these premiums, the insurance company agrees to provide financial compensation for a specified, and often very large, loss or event. Think of it this way. A financial plan is about building and growing your assets and income over time. Insurance is a defensive strategy designed to protect what you are building, while your emergency fund is there to handle a surprise car repair or a minor medical bill. Insurance is designed to address the kind of events that could be financially devastating, events that no reasonable emergency fund could cover. It transfers the risk of a massive, unpredictable loss from you to the insurance company. To understand how this works in practice, let's define a few more key terms. We've mentioned the policy, which is the contract, and the premium, which is your regular payment. When a covered event occurs and you need the insurance company to pay, you file a claim. This is the formal request for compensation under the terms of your policy. The The coverage is the maximum amount of risk or liability that is covered by the policy. Finally, many policies include a deductible. The deductible is the amount of money that you, the policyholder, must pay out of pocket for a covered loss before the insurance company's payment begins. Now, let's illustrate this concept by looking at some common categories of insurance. These are simply examples to help explain the role of risk transfer in different areas of life. One of the most common types is health insurance. The risk being transferred here is the potentially enormous cost of medical care. A major surgery or a serious illness can result in bills that are far beyond the capacity of most individuals to pay. Health insurance is designed to cover a significant portion of these medical and surgical expenses. Next is property insurance, which includes homeowners insurance and renters insurance. The risk here is the loss of your home or your personal belongings due to an event like a fire, a storm, or theft. It can also cover liability, your financial responsibility if someone is accidentally injured on your property. Auto insurance is another familiar example. It transfers the risk associated with a car accident. This includes not only the cost to repair or replace your vehicle but, just as importantly, the liability for any injury or damage you may cause to others. Disability insurance addresses a different kind of risk, the loss of your income. The risk being transferred is the possibility that an injury or illness could prevent you from working for an extended period. A disability insurance policy is designed to replace a portion of your income during that time, allowing you to continue meeting your financial obligations. Finally, there is life insurance. The risk transferred here is the financial hardship that the loss of your income could cause to your dependents upon your death. A life insurance policy provides a payment to designated beneficiaries, helping to cover expenses and provide financial stability. Each of these examples illustrates the same core principle. Insurance is a system where many people contribute premiums, creating a large pool of money. This pool is then used to pay for the large, unexpected losses experienced by a few members of the group. It is important to understand that insurance is not an investment. An investment, as we've discussed, is a tool designed to grow your money. Insurance is a tool designed to protect your money and your financial plan from a specific, defined loss. It is a cost you pay for peace of mind and financial security. The role of insurance within your financial plan is to act as a shield, ensuring that one unfortunate event doesn't undo years of careful saving and planning. With this understanding of risk management, we have now connected our core financial terms to both building a plan and protecting it. In our next chapter, we will shift our focus to another practical application: understanding the real-world implications of debt and credit on your financial life. Thank you for joining me today. I look forward to you joining me for Chapter 13. Hello and welcome back. In our last two chapters, we have been focused on the process of building and protecting a personal financial plan. We've seen how a budget and savings goals provide the blueprint for your financial future, and how insurance acts as a shield to protect that future from catastrophic risk. Today, we are going to dive into one of the most powerful and complex forces within any financial plan: the real-world implications of credit and debt. Our purpose in this chapter is to explore the dual nature of credit as a financial tool. We will connect the dots between the terms we defined earlier, like the credit card in Chapter 5 and the credit score in Chapter 6, and see how they interact within the larger context of a financial plan. As always, this discussion is for educational purposes. Decisions around using credit and managing debt are highly personal, and this information should not be considered advice. In a modern economy, credit plays a central role. At its most basic level, credit is a tool that allows individuals and businesses to purchase things now and pay for them over time. It can be a powerful enabler, providing a way to finance major, life-altering purchases that would be nearly impossible for most people to afford with cash on hand. Think about some of the most common long-term goals. For many, this includes pursuing higher education, purchasing a vehicle, or buying a home. These goals are often made possible through specific types of credit: student loans, auto loans, and mortgages. In this context, credit is being used as leverage, using borrowed funds to acquire a significant asset or experience that has the potential to provide long-term value. For example, a mortgage allows someone to purchase a home, which is a major asset. A student loan allows for an investment in education, which can increase future earning potential. This functional role is one side of the credit story. The other side of the coin, of course, is debt. Debt is simply the result of using credit. It is the money that you owe back to the lender. And debt is not free. The price you pay for the ability to borrow money is interest. This is where the concept of debt connects directly back to your budget, which we covered in Chapter 2. When you take on debt, the required monthly payments, which are a combination of repaying the original amount, or principal plus the interest, become a fixed expense in your budget. These payments claim a portion of your net income each month. As a result, the amount of money you have left over, your surplus, which is the fuel for your other financial goals, is reduced. The impact of this interest cost can vary dramatically depending on the type of debt. For example, with revolving debt, such as the balance on a credit card, the interest rates are often quite high. As we discussed in Chapter 5, if a balance is carried from month to month, the interest charges can compound, meaning you begin to pay interest on the interest. This can cause the total amount owed to grow quickly, making the debt payments a significant and long-lasting expense in a budget. Understanding the cost of debt is critical to understanding its true impact on your financial plan. Now let's connect these actions to another one of our key terms, the credit score. As we learned in Chapter 6, your history of borrowing and repaying money is meticulously documented by credit bureaus in your credit report. The way you manage your debt has a direct influence on the calculation of your credit score. For example, the act of making your loan and credit card payments on time, every time, is the primary data point for the payment history factor of your score. The amount of debt you carry, especially the balance on your credit cards compared to their limits, what's known as the credit utilization ratio, is a key part of the amounts owed factor. The real-world implication of this is that your past financial behavior, as summarized by your credit score, directly influences your future financial opportunities. When you apply for new credit in the future, such as a mortgage to buy a home, lenders will use your credit score as a tool to assess their risk. Based on their assessment, they will decide not only whether to approve the loan, but also what interest rate to offer you. A more favorable credit history and score is often associated with lower interest rates. Over the life of a long-term loan like a mortgage, a lower interest rate can translate into a significantly lower total cost of borrowing. In summary, credit and debt have a powerful, interconnected role in your financial life. Credit can be a tool that provides the leverage to achieve major goals. However, the resulting debt carries a cost in the form of interest, which directly impacts your monthly budget and your ability to save. The way you manage these obligations is reflected in your credit score, which in turn affects your ability to access credit in the future, and the price you will pay for it. Understanding this system is a key part of financial literacy. For those seeking more information, resources from nonprofit credit counseling agencies and the government's Consumer Financial Protection Bureau, or CFPB, can be valuable. We have now discussed building a plan, protecting it, and the role of debt within it. In our next chapter, we will bring many of these concepts together to look at one of the most significant financial milestones in a person's life. We will explore the vocabulary and concepts surrounding the process of homeownership. Thank you for joining me today. I look forward to seeing you in Chapter 14. Hello and welcome back. In our recent chapters, we have been connecting the dots, moving from defining individual financial terms to understanding how they work together as part of a larger system. We've discussed the framework of a financial plan, the protective role of insurance, and the complex nature of credit and debt. Today we will undertake a case study of sorts. We will explore a major life goal where nearly every single term we have learned in this series converges: the process of homeownership. It is essential to state our purpose up front. This chapter is an educational exploration of the vocabulary and financial concepts involved in buying a home. It is not real estate advice, nor is it a recommendation to buy or sell property. The decision to buy a home is one of the most significant financial commitments a person can make, and it should only be undertaken after careful personal consideration, and with the guidance of qualified professionals, including real estate agents, mortgage lenders, and legal counsel. Our goal today is simply to see our vocabulary in action. The journey to homeownership does not begin with looking at houses. It begins with the concepts we discussed in Chapter 11, building a financial plan. The first step is to look at your budget. A potential homebuyer would need to analyze their current income and expenses to determine how much they can comfortably allocate each month toward a new, and typically large, housing payment. This single piece of analysis informs the entire process. Next comes the crucial role of savings. Buying a home requires a significant amount of upfront cash. The largest portion of this is typically the down payment. A down payment is a percentage of the home's purchase price that the buyer pays in cash at the time of the sale, with the rest of the price being covered by the loan. In addition to the down payment, there are also closing costs. These are fees paid for the various services involved in finalizing the real estate transaction, such as the appraisal, the title search, and legal fees. Building up the funds for both the down payment and closing costs is a major midterm savings goal that is executed over time, often using a dedicated savings account. Simultaneously, the concepts of credit and debt come into the spotlight. A lender who is considering giving you a loan for a home will conduct a thorough review of your financial history. They will look closely at your credit score, as defined in Chapter 6, using it as a key indicator to assess their risk. They will also analyze your existing debt, often calculating what is known as a debt-to-income ratio, which compares your total monthly debt payments to your gross monthly income. This entire financial profile, built over years of managing credit, influences a lender's decision to approve a loan and the interest rate they will offer. Once the preparation is done, the next phase involves the loan itself, which is called a mortgage. A mortgage is a long-term loan used to purchase a property. Understanding the components of a mortgage payment is key. You will often hear the acronym PITI used to describe the 4 parts of a monthly mortgage payment. P stands for principal. This is the portion of your payment that goes toward paying down the original loan amount. I stands for interest. This is the cost of borrowing the money, the portion that goes to the lender as their fee. T stands for taxes. This refers to the property taxes that are owed to the local government. And the final I stands for insurance. This is for your homeowner's insurance policy, which we discussed in the context of risk management in Chapter 12. Many lenders will require that the property tax and insurance payments be included in your monthly mortgage payment. They will collect this money and hold it in a special account called an escrow account. And then they will pay the tax and insurance bills on your behalf when they are due. Mortgages themselves come in different types. A fixed-rate mortgage is one where the interest rate is locked in for the entire term of the loan, for example, 30 years. This means the principal and interest portion of your monthly payment will never change. An adjustable-rate mortgage, or ARM, is one where the interest rate is fixed for an initial period, say 5 or 7 years, and then can change or adjust periodically based on broader market interest rates. As a homeowner makes mortgage payments over the years, they build what is known as equity. Equity is one of the most important concepts in homeownership. It is the difference between the current market value of your home and the amount you still owe on your mortgage. For example, if your home is valued at $300,000 and you have $200,000 remaining on your mortgage, you have $100,000 in equity. Equity is your financial stake in the property, and it can increase in 2 ways: by paying down your mortgage principal, or if the market value of your home appreciates over time. As you can see, the path to homeownership is a real-world application of our entire series. It demands careful budgeting, disciplined saving, and responsible management of credit and debt. It requires understanding the vocabulary of lending to make informed decisions. In our final chapter, we will take a step back to review the entire journey we have taken. We will summarize the key lessons of our series and discuss how you can continue to build upon the foundation of financial literacy that you have established. Thank you for joining me for this practical application. I look forward to seeing you for our conclusion in Chapter 15. Hello, and welcome back for our final chapter together. For the past 14 chapters, we have been on a journey of discovery. We began with a simple premise, that the language of money should not be a barrier, but a bridge to greater understanding and confidence. If you have been with me since the beginning, I want to extend my sincere gratitude for your time and your commitment to learning. This final chapter is not an end point, but rather a commencement, a celebration of the foundation you have built, and a look ahead to your continuing journey with financial literacy. Let's take a moment to look back at the ground we have covered. Our series was built in 3 distinct phases. The first phase was all about definition. We took 10 of the most essential financial terms and demystified them, one by one. We defined the budget as our plan, understood the difference between gross and net income, and explored the roles of our checking and savings accounts. We unpacked the mechanics of the credit card and the meaning of a credit score. We then looked to the future, defining retirement accounts like the 401k and IRA, the assets within them like stocks and bonds, the popular vehicle of the mutual fund, and the entire system of the stock market. In the second phase, we moved to application. We saw how these individual terms do not exist in a vacuum. They are interconnected pieces of a larger puzzle. We assembled them into the framework of a personal financial plan, explored the protective role of insurance, and examined the powerful, dual nature of credit and debt in our financial lives. Finally, in our last chapter, we undertook a case study, seeing how nearly every term we learned comes into play during a major life event like the process of homeownership. If there is one central lesson to take away from our entire series, it is this: the ultimate goal of financial literacy is to achieve clarity. It is not about becoming a market expert overnight, or discovering a secret to instant wealth. It is about turning the lights on in a room that may have once felt dark and intimidating. This clarity is empowering. It gives you the ability to read a document from your bank and understand it. It allows you to listen to a financial news report and grasp the context. Most importantly, it empowers you to have more informed, confident conversations with financial professionals and to make decisions that are truly aligned with your own personal values and goals. The knowledge of this vocabulary transforms you from a passenger in your financial life into the driver, holding the map and the steering wheel. So, where do you go from here? The journey of learning is never truly over. The foundation you have built in this series is strong, and there are many excellent, unbiased resources available to help you continue to build upon it. For reliable, non-commercial information, a great place to turn is to government resources. The U.S. government's Consumer Financial Protection Bureau, or CFPB, has a vast online library of clear, impartial information on consumer financial products like credit cards, mortgages, and bank accounts. For educational material specifically on investing, the Securities and Exchange Commission, or SEC, runs a dedicated educational website at investor.gov. Reputable nonprofit organizations are also a valuable resource. Organizations dedicated to financial education and counseling, such as those affiliated with the National Foundation for Credit Counseling, or NFCC, can provide further educational materials and guidance. And never underestimate the power of your local public library. It is a treasure trove of books on every imaginable financial topic, available for free. The key is to continue seeking out knowledge from reputable, educational sources. As we conclude, I want to thank you once again for joining me. Taking the time to build your understanding of these topics is one of the most significant investments you can make in your own well-being and future. Remember that financial literacy is a marathon, not a sprint. Every small step you take, every new term you learn, and every concept you come to understand adds up over time, building a future of greater confidence and clarity. Let us end with our most important and final reminder. Throughout these 15 chapters, our goal has been to provide educational and informational content only. The information presented is not, and should never be considered, financial, investment, tax, legal, or any other form of professional advice. Your personal financial situation is unique. For guidance tailored to your specific circumstances, please always consult with qualified, licensed professionals who can properly assess your individual needs. Thank you for being on this journey. I wish you the very best in continuing to build upon your knowledge.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.